Joining me now to make sense out of what's going on as we begin this new year, John Lonski, Chief Economist, Managing Director at Moody's. John, great to have you here. Happy New Year. And we're off to right where we left off, volatility.
And I think that's going to be with us throughout the year. You know, we did get some help later in the day from the realization that, if anything, interest rates are going lower. And unfortunately, in a way, in response to this sell-off,
a lot closer to 2.5%.
We're going to be. We may be there very soon. And oddly enough, economists were predicting 3.1% on average in the first quarter.
You know who those economists are.
Right. They just parrot what the Fed says. And by the way, I was just looking at Fed funds futures. Fed funds futures, a 61% probability to Fed funds staying exactly where it is today, a 33% probability to a rate hike, only a 6% chance of a 33% probability of a rate cut, only a 6% chance of a rate hike.
Yeah, the idea that this Fed, no matter, I don't want to hear any nonsense, I don't know about you, from Jerome Powell again. This is not about the independence of the Fed. It's about its competency. Running off they've taken down $400 billion already off the balance sheet. They've got $4.1 trillion still to run off. They also have promised more interest rate hikes, including for this month. And as you say, that's changing very quickly. They've got to understand they cannot do this balance sheet runoff at the same time that they're raising rates. It's pretty simple.
Exactly. The Fed has to listen to those interest-sensitive components of the economy. Housing peaked back in the fourth quarter of 2017. It's been sliding since then. We also find in our own line of business, corporate bond issuance has hit the skids. That was off sharply in the final quarter of this year. And that might be telling us there could be somewhat of a credit crunch if the Fed goes ahead and hikes rates.
And no high-yield deals at all last month.
None by U.S. companies, but we did get, I think, 8 high-yield deals from Chinese companies. A lot of these companies having exposure.
So, okay, let's hold the war with China until they close.
At least somebody's using the dollar-denominated corporate bond market.
Well, and guess who it would be? It would be the Chinese. But as we look at what's going on with this market, 3.7 billion shares. You can see that there's so much caution now in the air. With Apple today, saying that they're not going to get close to guidance. This is a difficult little pill to swallow for investors. Tomorrow, we're down on the futures, and you looked just before you went
by more than 300 points
on the Dow, and we know that this is going to amount to, at least on that projection for Apple, about somewhere around 80 points off the Dow tomorrow morning.
Yeah, and Apple, of course, was counting on sales in China. We had a very weak reading on Chinese manufacturing activity for December. That was. And you were talking about the decline in copper prices. Well, the slump in industrial metals prices reflects a global weakness as far as manufacturing goes.
You know, I deeply respect you, first as a man, and secondly as an economist, but I got to say, riddle this for me. We've got 2.5% now suddenly on 2-year. We've got suddenly gold rising, and we're looking at commodity prices generally falling. This looks to me like more of a disinflationary environment. Why in the world is gold going up? That's just an academic question.
Well, that's just, a sense of if everything else fails, I'm going to go to gold, okay? The investment of last resort.
I was afraid that'd be the answer.
Speaking of prices, one of the reasons why Apple may have gotten itself into trouble is because they were too aggressive with price hikes on iPhones. Note the auto industry. Earlier last year, in 2018, auto sales were going down because prices were too high. Detroit cut prices. Auto sales came back.
If any company in America thought it had pricing ability, it was Apple. This is a lesson. They do not any longer. John Lonski, as always, instructive. Thank you, sir, for the tutorial.
My pleasure.
John Lonski.